Introduction. Thank you for purchasing this audiobook, and let me welcome you to the threshold to financial literacy. Now, you hold the key toward freedom. You won't have to work for money anymore. Instead, your money will work for you. This audiobook will help you understand the basic concepts of stock market trading. You will also find the best practices that stock market professionals share. The fact that you are listening to this audiobook right now shows that you are interested in the stock market and in ending your worries about the future. Well, you made the right choice. This audiobook will equip you with the knowledge and skills that you need to excel in the field of stock investing. What you will learn from listening to this audiobook will help you make empowered choices and reach your goals. Again, thank you for buying this audiobook, and I hope that you will realize how it is a worthwhile investment of your money and your time. Chapter 1. Stock Investing Basics. Stock investing is often one of the solutions for employees who have no plans of being employees until they retire. They know better than to settle on what they will get from their salaries and pensions upon retirement. A comfortable life means you do not have to work to earn money. You must decide to make your money work for you instead. That is why stock investing continues to grow more popular as more and more people recognize the ingenuity of investing in stocks. Many wealthy people who have made it to the top have invested in the stock market. Those who invested $10,000 about 50 years ago would have raised the value of their investment to more than $1 million. Their success stories have inspired many other investors to follow suit. While stocks have a proven track record of contributing to many people's wealth, it is important to remember that it requires time and patience. After all, owning a company's stocks is more than just passive income. It means that you partially own the company. It is a good thing that stock ownership is more accessible nowadays. Even with little money, you can start investing in the stock market. It is also easier with the advent of stock trading applications that you can download and use on your smartphone or computer. There are some factors that you need to consider to identify your financial status. These factors include after-tax income, overall debt, regular expected expenses, net worth, and more. Of course, when you invest in stocks, you expect to get a profit. That is where it gets tricky. You cannot automatically expect to make money when you invest in stocks. It is a field wherein you must make the right decisions at the right time. Only then will you maximize your profits. Things to keep in mind when it comes to the stock market. Stocks are classified as common or preferred. The differences in dividends and voting rights distinguish common from preferred shares. The majority of investors in a publicly traded corporation own common stocks. There is no certainty that common stocks will pay dividends or dividend amount will be set. As a general rule, common stockholders have voting rights proportional to their stake in the company. Most companies count each stock as one vote. This means that owning more stocks gives you more chances of being heard in the decision-making within the company. Meanwhile, owners of preferred stocks can expect to receive a fixed number of dividends each year. In the event of a company's bankruptcy, preferred stockholders receive in the liquidation of the company's assets before common stakeholders receive their part. On the other hand, preferred stock owners do not have the power to vote. Remember that financial institutions and brokers usually require a minimum investment amount. Therefore, you need to do some research to find the broker that would accept the amount of money you will invest. While some brokers do not require a minimum deposit, you must check their fees carefully to ensure you can afford to pay them and still make a decent profit. Fees. Of course, brokers need to make money. That is why they also require fees. Usually, you need to pay a fee each time you purchase or sell stocks. As a result, you lose more money to pay for fees when you often buy and sell stock. Indices. Find reliable indices to guide you in making trading decisions. Losses. Remember that stock trading is never all rainbows and butterflies. There is a good probability that you will witness how your stocks decrease in value. However, it is normal. You just need patience and the heart to weather the storm, because there is also a good probability that your stock's value will rise again. Equity investing. This is what usually comes to mind about the stock market. It is the buying and selling of stocks. It is the process of buying stocks so the investors can sell these stocks at a higher price when their value goes up. That is the biggest goal of equity investing, to earn profit by trading. Individual stocks. Although this is not recommended, some beginners do not have a lot of resources, so they have to settle for individual stocks. It means that you own just one kind of stock. It is also risky because you can lose all your investment at once. Blue chip stocks. These stocks got their name after poker chips. If you are familiar with poker chips, you know that the blue ones are the most valuable. That is because these stocks are considered as most stable, consistent, and prompt in paying out dividends to stockholders, as opposed to flashy stocks that give you more money faster. Blue chip stocks give out steady and reliable income. Preferred stocks. Unlike common stockholders, preferred stockholders do not have voting rights. However, they get their dividends first. They are also insured. That means that in instances of bankruptcy, the preferred stockholders get paid first. Penny stocks. These are the cheapest stocks available. That is why it is so popular with beginners. However, experts warn the public about these stocks as they are volatile. Owning stocks is one thing, but being able to sell those stocks is yet another matter. Flashy stocks. People call them flashy stocks because they easily catch your eyes. You must be careful of these stocks. Sometimes they prove to be a worthwhile investment. However, trading with flashy stocks is often tricky. Therefore, experts do not recommend it for beginners. Instead, experts encourage beginners to invest in reliable and rock-solid companies. Once you have more experience, you will have more confidence to deal with flashy stocks. Investing personalities. Once you have made up your mind about investing in stocks, there are some things that you need to consider. One of these is your personality as an investor. There are 3 classifications of investors, depending on your risk tolerance. Conservative investor. If your philosophy in investing is making a profit slowly but surely, then you are a conservative investor. Conservative investors are willing to wait for their profit to accumulate as long as the risk of losing their profit is low. That is ideal for employees who want to work while investing in stocks. Aggressive investor. If you love challenges and believe you have the skills to make the correct decisions at the perfect time, or you have strong faith in your intuition, you may be willing to invest your money for higher profits. If this is how you want to invest, then you are an aggressive investor. Often, the stock with greater risk gives greater profit for your investment. Moderate investor. Moderate investors want a balance between the risk and the amount of profit they may make. Another way of classifying investors is according to their involvement in stock trading. Some investors invest their money in stocks and recheck their value after a long period. On the other hand, some investors are more active in trading and buy and sell stocks as often as needed to make more profits. Chapter 2. Stock market. Those who have learned how the stock market works later in life wish they had known about it sooner. The sad thing is that this is not something they teach you in schools. However, it would help many people if they educate the students about the stock market as part of a financial literacy program. It seems like no matter how long you have been trading, there are still things that you can learn about trading. Beginners, especially, have a lot to learn about it. However, one of the most challenging things about engaging in stock trading is knowing how to get started. Fortunately, there are many available resources that you can use to learn more about the stock market. If you do not know the basics of the stock market, the financial news you hear in the media may sound like nonsense. If you are in for the long haul, like with a retirement-oriented mutual fund portfolio, you do not have to worry about the jargon or the flashes of red and green on your TV screen. You do not need to know much about the stock market to get by. To become a stock trader, on the other hand, you must have a fundamental understanding of the stock market and some knowledge of how stock trading works. Some skills you need to possess and develop include stock evaluation, basic research, critical thinking, and lots of patience. After all, not many people have money lying around waiting to be invested in something or as payment for something. For most beginners, their funds for stock trading are supposed to be spent on something entirely different, such as emergency needs, tuition, holiday funds, and savings. Therefore, you need to trade wisely. However, if you have available money that you would not need for years, you can use that to invest in stocks. This is called asset allocation. Instead of just saving it somewhere, you can make that money make even more money for yourself. Asset allocation is highly recommended for young investors. That is because they have more time to spend trading. However, that does not mean that the older investors would not benefit from asset allocation. With the right decisions, anyone can benefit from this concept. Testing the waters with stock market simulators. Some may have apprehensions about investing their money in the stock market, especially those who have zero experience with trading. The good news is that there are different stock market simulators that you can use for practice. Some of these simulators are free to use, but some require payment. Of course, you can expect that the paid ones have more helpful features than the free ones. However, if it is a basic practice that you need and you are also apprehensive about spending money on practice, then you should go for the free stock market simulators. The simulators allow you to use virtual or imaginary money so you can build your virtual stock portfolio. Here, you will see the activities in the stock market, the dividends you will get, the trading fees you need to pay, and the consequences of each step you take when trading stocks. With these simulators, you may practice without the risk of losing money. Some simulators allow you to compete with other practicing traders so you can experience what it is like when you have to consider competitors as well. Chapter 3. Stock Market Investing. When you invest in stocks, you acquire equity shares, also known as ownership shares. The return on investment, or the proportion of your investment that you receive back, is contingent on the success or failure of that company. Companies sell shares of their stocks so they can raise more money for their operations and expansion. You anticipate profiting from its success and profits generated by its product or service sales. However, you should not let this intimidate you and stop you from investing in stocks. Now there are tools to make stock investing and trading easy for you. You need to take it seriously and understand how it works so you won't get frustrated when you experience setbacks. There are two primary strategies to profit from stocks. The first one is dividends. When public firms are profitable, they have the option to transfer a portion of their earnings to shareholders in the form of a dividend. In place of the income they no longer receive from their occupations, many retirees invest in dividend-paying equities. Stocks that pay higher dividends than the average are commonly known as income stocks. You can cash out the dividends or reinvest them to purchase additional company shares. Benjamin Graham is one of the names popular when it comes to value investing. He is a firm believer that instead of the profit you get from trading, it is the dividends, interests, bonds, established security, and the long-term benefits of owning stocks that will give investors real money. The second one is called capital gains. When the price of a stock rises above what you paid for it, you can sell your shares for a profit. These earnings are capital gains. In contrast, if you sell your stocks for less than what you paid for it, you have experienced a capital loss. Throughout each trading day, traders purchase and sell stock frequently, and their prices constantly fluctuate. What exactly is the purpose of participating in the stock market? The purpose of the stock market is to create a venue where individuals with varying degrees of financial means can acquire and sell ownership stakes in publicly traded companies. Stock market activities happen by dividing the control of some of the largest corporations in the world among the hundreds of millions of individual investors. The investors' decisions regarding their purchases and sales of stocks determine those companies' value. Why do stock prices go up and down? The price of the assets depends upon the supply and demand. Identifying the levels at which the investors and traders are willing to buy or sell. The procedure is called price discovery, and it plays an essential role in the functioning of the market. The process of assessing how new information will affect the value of a company involves the discovery of prices, which plays a crucial part in this process. Price haggling is allowed between buyers and sellers thanks to the market. This negotiating ensures that both sides receive the highest amount of justice possible by delivering the highest possible selling price and the lowest possible buying price at any given time. Stock prices go up and down because they are highly volatile. As an example, during the lockdowns due to COVID-19, the stock prices fell by almost 50%. Before the COVID-19 pandemic, you would think it would stay that way as long as the virus is still here. However, in just a couple of months, the prices went back up and even reached a record high. Investing information in the stock market. Due to war, supply chain concerns, rising interest rates, high inflation, and stock market volatility may rattle even the most seasoned investors. An investor's best action course in good and bad times is to hold on to a diverse portfolio of equities or stock index funds. Stock trading is a popular pastime for those who prefer a little more excitement. Investing in the stock market entails purchasing and selling shares, often to profit from the market fluctuations. Traders use short-term market occurrences to make money selling stocks or buying low-priced equities. They buy and sell multiple times during the day. That is known as day trading. In contrast, many busy traders only make a few trades each month. Chapter 4. Importance of a diverse portfolio. As an investor, you cannot avoid experiencing a bad market. Avoid the danger of an undiversified portfolio by diversifying your investments. A well-diversified portfolio can shield you from the inevitable downturns in the market. Investors diversify their holdings to reduce the chance of a single stock's tainted stake, wiping out their entire portfolio by purchasing different equities. However, assembling a well-diversified stock portfolio necessitates a significant investment of time, patience, and effort. You will also need more money since you will purchase different stocks. That means that you will also pay multiple fees. Since you place your investments in different stocks, you have less chance of losing. You may lose profit in a specific stock, but make more in others. It operates on the principle of not putting all your eggs in a single basket. You must remember that a diversified portfolio will require higher investment amounts because fees apply to each kind of stock. You need to consider those fees. Likewise, it will also require more time. That makes it more challenging for beginners. A mutual fund, an exchange-traded fund, or an index fund is a substitute for direct investing. Putting your money in these is automatically invested in different things. Remember that you may often pay fees when you invest in mutual funds. These fees may be of significant amount too, especially the management expense ratio. Other fees include loads or sales charges. However, this is a popular choice among beginners because no matter how much money you invest, the fees are the same. Short-term traders buy and sell stocks. Long-term investors acquire and keep stocks. Investors cling to a diversified portfolio of equities in good and bad times. However, you need to be careful about over-diversifying just to have a diversified portfolio. If most of your portfolio consists of one kind of stock, it is perfectly fine. Also, over-diversifying means you will be paying more fees than you should. Stock investing takes time. Each stock you buy should be thoroughly researched, including its financials. To save time, many investors invest in equities via mutual funds, index funds, and ETFs. It allows you to buy numerous equities in one transaction, delivering rapid diversification and eliminating investment effort. If you want to earn money through stock trading, you should be willing to let your money sit for at least 5 years. Another concept that you should do when you diversify your portfolio is rebalancing. Patience does not mean sticking to your initially purchased stock until the end. There are times when you also need to make changes in stocks and their respective amounts to ensure that you maintain or even improve the overall status of your portfolio. How to invest in stock market. After deciding to invest in the stock market and considering all the factors needed to make a wise choice, the question now is how to invest in the stock market. That is usually one of the problems that potential investors face. How do they invest in the stock market? Here are some ways to do it. Your employer. Your employer or company you are working for may offer stock ownership and discounts for their employees. You can set a particular percentage of your salary to go to stock investments. Such contributions are usually not heavy on the pocket. Therefore, you can still enjoy your salary while preparing for the future through your contributions. Some companies offer stocks as part of the benefits for retirees. Your choices may be limited as to the plan packages as well as brokers, but this is a good start. Apps. There are available apps that you can download and use to purchase stocks. Apps usually require lower investment amounts. It is also easy and convenient because you can trade stocks using your smartphone. Full-service brokers. These are experts who do everything for you. Therefore, their services cost more. However, you also have more chances of earning profit from your stocks. Discount brokers. You will be in charge of your stock trading activities with limited support. Discount brokers are more like financial advisors whom you can ask when you need information or assistance about trading. In choosing the stocks you want to include in your portfolio, you can consult professionals if you have the means. Otherwise, there are available resources online wherein you can find information about new companies that have the potential to increase their stock's value. You can also seek professional help running research or do it on your own. Offline, you can observe what most people are interested in. You can monitor trends and even ask for your friends, relatives, and colleagues' opinions. If you prefer not to trade alone, you can look up investment clubs you can join. It is a perfect opportunity to get exposed to different trading personalities. You will also be able to learn from traders of different levels of expertise. You may learn a thing or two in such clubs about trading before you go solo. They may require membership fees, but in exchange, you will get more experience, get inside information, and engage in low-risk trading. As research is very important for stock market investors, you also need critical thinking, especially in identifying which books and authors you would follow. You may even break it down into which ideas you would apply. You also need to know how to apply the knowledge that you gain from your research. Reading will help you a lot, and it is a wise investment of your time. It may sound passive, however, it means being equipped to face challenges you may encounter when you start trading. If you think investing and stocks are your expressway to being rich, you are dead wrong. Yes, it can make you rich. However, it is not an expressway. You must be patient in waiting, be highly observant and intuitive, and you may experience losses along the way. Just like with driving, it seems like too much information. It sounds so complicated that it would take years to learn how to trade stocks. However, when you get started, it will all fall into place. It will all click together. Still, you would need practice if you want to maximize your earning potential and develop your skills as a trader. You will need to read a lot of learning resources. Some people even attend formal training. Just like everything else, you need to invest your time, effort, some finance even, and focus on learning to excel in trading. Start now. Most people are good at planning, but plans are no good if you never put them into motion. Without action, plans and dreams remain just as they are. If you would always wait for the perfect timing, it may never come. As a result, you won't get started at all. Do not let procrastination get in the way of your success in the stock market. You need to understand that the time you spend waiting for the right time may just be the time that you are kept away from your success. Act now. Invest now. Chapter 5. Advice from the stock market experts. Learning always begins with a question, with curiosity. This is a good sign. It means that the interest and the readiness are there. Now, all you need are experts who can guide you or give you the information you need. Here are some of the well-known professionals in the stock market, as well as the learning resources that they wrote and published. Benjamin Graham, father of value investing. Graham was the mentor of Warren Buffett, who is well known in the modern investing field. He wrote a comprehensive book entitled The Intelligent Investor, the definitive book on value investing. It teaches readers how to evaluate a company's worth and whether it is a worthwhile investment or not. His evaluation method is based on the company's financial value. He established a margin of safety, which is a reliable concept when evaluating a business's financial value. The book's revised edition included contextualized and modernized commentaries about its content from a personal finance expert. Jason Swig. The collaboration created 500 pages of information worthy of your time, as knowledge is a valuable investment. John Bogle, mutual fund revolutionary. Bogle established a legacy of being a relentless investment advocate. He is an index fund pioneer who opened the doors to building a low-cost, diversified portfolio. He wrote a book for investors to help them maximize their earning potential. His book is entitled The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. Warren Buffett, serious yet humorous modern investor. Buffett is known as one of the best modern investors of this generation. He established his reputation as he led Berkshire Hathaway as the CEO for more than half a century. He capitalized on companies' margin of safety when purchasing them as investments. People loved his annual letter to his shareholders. These letters are published on Berkshire Hathaway's website. His writings are humorous, yet full of valuable investment information. A collection of his essays was made into a book entitled The Essays of Warren Buffett, Lessons for Corporate America. Ramit Sethi, Debt Terminator. Sethi's book entitled I Will Teach You to Be Rich shows his commitment to helping students avoid loans or be debt-free. He outlined a training program to help young adults master the 4 pillars that will help them excel in their finance. He identifies these 4 pillars as banking, budgeting, saving, and investing. He teaches investors how to indulge in guilt-free spending and how to ensure an individual's growth with his or her finances. The latest edition of his book also features stories from reader contributors and an analysis of investment psychology. Burton Malkiel, Strategic Economist. His book entitled A Random Walk Down Wall Street, The Time-Tested Strategy for Successful Investing, refutes the information that Benjamin Graham wrote in his book. He explains how the analysis of companies' financial worth won't help you make the best stock investment decision. He shares his expertise and his strategies in his book to help out investors and empower them so they can make wise decisions. Christine Benz, Practical Finance Advisor. Benz puts all the information that you have gathered about stock market investments and breaks it down into smaller, more practical steps so you can apply what you have learned. You may have a hard time understanding and putting together all the theories about the stock market, so Benz makes it easier for you. Her book, Morningstar's 30-Minute Money Solutions, a step-by-step guide to managing your finances, guides you so you can apply those theories to your real-life finances. Some of the steps included in the book are net worth assessment and finance organization system. Other parts of the book discuss advanced concerns such as retirement investing, estate planning, and college saving. Taylor Larimore, Michael LeBouf, and Mel Lindauer, Masters of Investment Discoveries. Their book entitled The Bogglehead's Guide to Investing emphasizes and deepens John Bogle's concepts and ideas in his book. Their book consists of 23 chapters that simplify investing information and present them in a light-hearted manner. The book contains valuable bits of advice from the trio and their discoveries as they strive to deepen their knowledge about stock market investing. It also discusses specific topics that are investment-related, such as choosing a financial lifestyle and other factors that will help you master financial literacy. The reiterated Bogle's principles, including the importance of starting young, saving, the beauty of simplicity, living below your means, diversification, and the importance of sticking to your plan whatever happens in the marketplace. They have a solid following who likes to discuss these things in an online forum. Choose your brokers. Finding the perfect brokers for your needs and preferences is also important. It is important to choose licensed brokers to handle your stock investments. You should check their credentials and their reputation. You also need to consider their cost and features. While most brokers are often within the same price range, looking closely at the features they offer may help you choose the best broker for you. Some features you should look for are educational materials or learning tools and free access to investment-related studies. These features are helpful for beginners. Some brokers allow you to participate in the foreign stock exchange. Doing that will help open a whole new world of trading opportunities and challenges. You may also look for brokers that offer a user-friendly and beginner-friendly platform. Some brokers offer a trial or demo so you can use their services without paying for a specific period. Conclusion. Thank you for purchasing and downloading my audiobook. I hope this audiobook was able to help you to take control of your life, specifically your economic status. The next step is to plan carefully, execute with patience and consistency, and evaluate the steps that you took in stock market trading critically. Again, thank you and good luck. This is the end of Beginner's Guide to Stock Market Investing. Learn all the basics of stock investing that would help you get ready to make your first stock market investment. Written by Zeki Osborne. Narrated by Stephen Miles. This is how to make money in momentum stocks. Learn about momentum investing, understand market trends, and discover the strategies on how to earn the most profit. Written by Rue Fouche. Narrated by Stephen Miles. Introduction. Momentum investing is a type of investment strategy where you will find securities that have gained an upwards momentum and then sell at a higher price. The goal in this investing and trading strategy is to ride the momentum of the price swing while it's still on the rise. When the trends show you that the price is at its peak, then it's time to sell your holdings to take profit. On the outset, you'll notice that this type of investing and trading requires one to understand and take advantage of market volatility. You'll be looking for short-term uptrends and downtrends, riding momentums as you look for opportunities to take profit. Momentum stock investment takes skill, patience, and a sound strategy because you need to know how to spot an uptrend in the market, ride the wave, exit when you've made profit, and repeat the process. You'll need to use both the fundamentals and technical data to spot these trends. Just like any other type of investment or trading, momentum stocks carry a considerable amount of risk. For instance, if you enter into positions too early, then you may end up riding the wrong trends, downtrend instead of uptrend and vice versa. Sometimes you may end up closing your position too late in the trend and take some losses. It's also possible to miss technical deviations, key trends, and just get distracted while you're looking for the next trend wave. What you're trying to do in momentum stocks trading and investing is to take advantage of market volatility. You're like a surfer riding a wave. Once you've reached the crest, you'll bail and move to the next wave. There are several concepts that you'll need to learn when you try this type of investing or trading. The risks involved and the timing of entry and exit positions, selecting the right equities, how to time your entry, how long you should hold your positions, consistent charting to identify the right exit points. Chapter 1. Momentum Investing Basics. Momentum investing is often compared or contrasted with long-term stock market investing. Some ask if the same rules apply for both strategies. There are similarities between these two, and there are differences as well. When it comes to momentum investing, you're selling, losing stocks while buying winning stocks, which is in stark contrast to the age-old trading principle of buying low and selling high. What is momentum? So, what is meant by momentum in momentum investing? Momentum refers to the rate of returns that you can gain from a particular stock or security. In this type of trading or investing strategy, you're going to look for securities that have had a history of high returns for a specific period of time, say a quarter up to an entire year. At the same time, if you have stocks or securities in your portfolio that have lost momentum, i.e., not providing solid returns within the same time frame, your strategy tells you to take a short position on those assets. Given these premises, you can say that in momentum investing, your goal is to capitalize on the potential continuance of a given trend in the market. You'll be following a strict set of trading rules that will be based on certain indicators that will dictate your entry and exit positions. In short, you will be trading with the trend, regardless of the current market price of a security. As long as the trend continues, you will maintain your position until the trend reverses. In this regard, you can say that momentum stocks are better used by the trader than the investor. Investors are market players who tend to buy and hold on to their assets. They're not particularly looking for a quick profit. Traders, on the other hand, aren't waiting for long-term gains. Both market players follow the trend, but the trader won't stick around long enough to receive dividends, whereas investors can choose to keep their holdings following the long-term trends and win larger capital gains over time. The finer details of momentum investing. Based on the definitions we have proposed earlier, momentum investing is not for everyone. You're doing more trading than investing most of the time, since you're only going to hold your position for the short term. You're particularly looking for an upward trend when you look at different exchange-traded funds, ETFs, futures, stocks, and other securities and financial instruments. You take a long position while the price trend or momentum is still going upwards. Once you see the signals tell you that a downward trend is coming along, you're switching to a short position and will be ready to take profit. Take note that this investment strategy assumes that trends can persist for a given time. It also assumes that you can take profit by following the upward trend and will be able to identify a reversal. Is there evidence to prove this theory? There is. Back in 2009, various momentum investors entered the stock market in the US and have generally made good profits while the economy was on an upward trend. However, the uptrend that they enjoyed ended by the end of 2018, when the stock market crashed in December. During that time, the S&P 500 dropped by more than 9%, which sent investors into a panic. They believed that the economy was going to slow down if the central bank would tighten its current monetary policy. It was a self-fulfilling prophecy, and the market did crash, but momentum investors have already taken profit by that time. Again, trading momentum stocks isn't for everyone. If you have the appetite for active trading and making quick profits as you identify profitable trends, then this type of investing is for you. But if you're more conservative in your investing approach, then you may not find this type of investing favorable, and you may end up making bad decisions along the way. This type of investing requires a lot of discipline and abiding by the signals you've acquired from your technical and fundamental analysis. Chapter 2. Tools needed for momentum investment. Now that you know the signals of a potential bullish or bearish stock, you can use those signals to identify the ones that are on the verge of exploding at a higher price. Remember that you're not just looking for a stock that is on a generally upward trend. You're searching for stocks with prices that tend to go up rather quickly so you can maximize profits. What Jim Cramer is hinting at here is that you shouldn't focus only on the fundamentals when trying to spot upward momentums. It's also just as important to check the technicals, which is what we're going to focus on in this chapter. Technical indicators signaling an upward momentum. You use technical analysis to determine the strength of any momentum for any stock, security, or other asset. What you're looking for is the speed at which the price is rising, and the indicators we'll go over here will help you identify it. When the price of any given asset weakens, it means that it is already overbought or oversold, which will hint that a reversal is on the horizon. When stock prices come close to the average or midline, then it means the price change is slowing down and it's time to either buy or sell, depending on the direction of the momentum. Tools for momentum investment. Some of the tools for momentum investment include the following: relative strength index, stochastics oscillator, price rate of change, moving average convergence divergence. Rate of change. Rate of change refers to the speed at which a certain value will change, given a specified period. The rate of change is expressed as a ratio that compares the rate between two variables. On the charts, the rate of change will look like a slope of a line, which represents the percentage change in the values, and that tells you the momentum of the current security you're looking at. To compute for the rate of change, you'll need to use the following equation. Rate of change equals current value of stock previous. Value of stock 1 to 100. So how do you put this tool to use? After computing the rate of change of a given stock, you compare its performance against the market in the short term. If the stock outperforms the market, then you know that it has a positive and fast momentum. That means you should buy and take a long position. However, if the stock underperforms compared to the market, then it tells you that the momentum is slowing down. Maybe the stock is getting overbought and oversold, and a decline in value is coming along. If that is the case, then it's time to sell or take a short position. Moving average convergence divergence. The moving average convergence divergence reflects the link between two moving averages to help you determine the price action. To do that, take the 26-day moving average of a stock or some other asset and subtract it to the 12-day exponential moving average. On the charts, the result of this computation will produce two lines. The 9-period moving average convergence divergence line, also known as the signal line, and the moving average convergence divergence line. The signal line is thereafter transposed over the moving average convergence divergence line, and you buy or sell, depending on where the moving average convergence divergence crosses the signal line. Relative strength indicator. The relative strength indicator is the technical tool you'll use to determine the magnitude of price changes in a given stock or security. It measures the average gains and also losses, covering a total of a 14-day trading period. Because of this, you can use the relative strength indicator to mark overbought or oversold assets using its bounded range values from 0 to 100. When the values reach 70 or higher, it indicates that the stock is overbought. However, when the value goes 30 or below, then the stock is oversold. Stochastic oscillator. A stochastic oscillator is a tool that measures the closing prices of a stock or security and then compares it to a set of historical prices given a specific time period. It is also another tool you can use to determine overbought and oversold stocks, just like the relative strength indicator. It also has a bounded range from 0 to 100. When its value goes up to 80 or higher, then you can say that the stock is overbought. However, when the stock's closing price drops to 20 and below, then you can say that it is oversold. When the values or closing prices of stocks enter within these two ranges, you can say that a trend reversal is about to happen, which means oversold stocks will take on an upward trend, time to buy, and an overbought stock will switch to a downward trend, time to sell. Chapter 3. How to identify bull and bear markets. One of the first skills that you should learn before jumping into trading momentum stocks is being able to identify bull and bear markets. You can't ride an upward trend of a security if you can't tell whether it's bullish or bearish, i.e., in an upward or downward trend. What is a bull and bear market? You may have heard several animal names used to describe the market conditions in securities trading. Two of the most common animals that have been mentioned a lot are the bull and the bear. When market analysts mention the bull in their reporting, they're referring to a market condition that is characterized by securities on the rise or headed on an upward price trend. Its opposite, on the other hand, is called a bear market. When the market or a given security is said to be bearish, what that means is that its price trend is in a downward direction. A bullish market indicates that there are more people willing to buy a stock, future, or other security. On the other hand, during a bearish market, it tells you that more investors and traders are selling their holdings, which drives the price down due to a higher supply. Understanding a bull market. One of the skills that you need to obtain if you want to learn how to trade momentum stocks is identifying bull markets or securities that have an upward price trend. These are the securities that you will want to buy into and take a position and ride the upward trend so you can sell your holdings later at a higher price. A stock or security with bullish conditions tends to have its price rise continuously. Of course, you should expect pullbacks at every point when you look at the price charts. We'll cover that in detail later on. The term bull market can be applied to the stock market, but it can also be applied to anything that is trading, such as commodities, currencies, real estate, and bonds. Remember that the prices of these securities tend to rise and fall during the course of a trading day. However, there are periods during trading when the price tends to have extended periods of rising. When you see this continuous rise in the price, you're looking at a positive momentum, and that signals you to buy into that security or stock. Now, before moving forward, here's a rule of thumb you should remember. When the price of a stock or other security rises 20% after it has declined 2 times by 20%, you can say that this stock is in a bullish state. The price is heading into an upward trend. There are several strategies that you can employ when you're dealing with a bullish market. For instance, if you want to profit from the bull market, you can use an increased buy, hold, and retracement strategy, which can be used to take profit later on. Positive market insight. Bull markets usually mean that more investors have a more positive view or take about a certain stock or security. Investor confidence is also pretty high about the stock of a company, which is why they are happy to keep their shares and enjoy rising prices. However, it isn't always easy to predict how these market players will behave, which is why you need to use fundamental and technical analysis, which we will touch on later, so you can figure out when it's time to buy and hold or sell and take profit. These tools will allow you to avoid the speculation and psychological effects that drive other investors into making hasty decisions. Again, there is no specific metric that you can use to identify a bullish market or stock, but there are indicators that you can use to confirm things. For instance, back in 2003 to 2007, the S&P 500 experienced a 20% increase after previously experiencing a downward trend, which is around 20%. These significant gains were then followed by a strong decline in prices in 2008, which led to the financial crisis that year. That period of significant growth was a bull market run, and it lasted for several years. How long do bullish trends last? A bullish trend can last anywhere from several months, and in some cases, it can even last several years. A bullish trend or market will usually coincide with the stages of the economic life cycle. 1. Expansion. 2. Peak. 3. Contraction. 4. Trough. 5. Expansion. Remember that the start of a bullish market trend usually indicates economic prosperity in a given country, and it will be followed by economic growth. When growth is projected, you should expect other good signs and news about a country's potential growth. This news and overall positive outlook drives investors to participate in the market and fuel the rise of an economy. However, apart from these indicators, there are other ways, i.e., more quantitative methods, to confirm the financial upswing coming from a bullish market, which will be covered in the next section. The signs of a bull market. Notice that bull markets and bullish stock trends tend to occur during times of peace and when the economy is gaining strength. In many cases, they also tend to reflect a country's gross domestic product, GDP. You will also spot them when more companies report better corporate profits, which also result in a decline in the country's unemployment rates. Another fundamental indicator you should pay attention to is investor confidence, which tends to climb higher during a bull market run. Notice that there will be a higher demand for different stocks. In addition, you will also see a lot of IPO activities during a bull market. However, do take note that it's impossible to predict exactly when a bullish market will start and finish. You can only identify the exact dates when they happen. However, notice that when investor confidence rises, you will see more people buying and selling their shares, which increases the demand. The rise in the prices of stocks, commodities, and securities is driven by supply and demand. Since more investors are interested and confident in a growth-driven market, then expect the prices to go up, which in turn helps to boost the onset of a bullish market. Market expansion, pandemic, rebound. Now, let's look into a bit of history to demonstrate this point. We'll be looking at the Dow Jones Industrial Average Chart from 2017 to 2020. After the financial crisis of 2008, the market bounded back and had another bull run the following year. Of course, there were a few market corrections that came along the way, but the trend continued on an upward slope. The year 2017 is a good point in time to show that upward momentum. We can see that prices went on an upward trend beginning in 2017 and peaked at some point at the start of 2018. The market was a bit indecisive during 2018 and security prices even went below the 25,000 mark by November 2018. A contraction followed by a trough. However, by 2019, the prices went back to an upward trend once more until that huge nosedive on March 6, 2020. It was the beginning of the COVID-19 pandemic, which is again another contraction followed by a trough. After that, what comes next? Even after a pandemic that brought global markets and economies down to their knees, the next phase in the economic life cycle still followed. The market made a remarkable rebound within a few months. Notice the formation of an M pattern in the chart around September to October, which was followed by another upward momentum in December of the same year. What's the lesson to be learned here? Economic downturns that drive bearish markets are a natural part of the economic cycle. When that happens, you need to watch and wait out the bearish momentum and look for signals that can indicate the eventual coming of a bullish reversal. Again, as it was mentioned earlier, look for a 20% increase in stock prices, which can indicate the start of a bullish trend. This incremental rise can go on for months and years. This usually happens after a 20% decline. When you see that decline followed by an increase of 20%, then it can be a good time to take your positions, i.e. buy stocks and other securities. However, if the decline that you're looking at only caps at 10% or less, then it doesn't confirm a bullish market, but it only indicates the market correcting itself. Market indicators that signal a bullish trend. Apart from checking out market conditions and price trends, there are other key indicators that you can use to assess the market, which include the following. 1. Top-line growth. 2. Bottom-line growth. 3. Price-to-earnings ratio. Top-line growth. Top-line growth refers to the amount of revenues or gross turnover that businesses are able to make. A high top-line revenue indicates that a business has a high top-line growth. Further, compare a company's top-line growth to that of the country's GDP. If the top-line growth increases in line with the GDP, then there is also a higher demand for that company's stock. Bottom-line growth. If top-line growth reflects revenue, bottom-line growth, on the other hand, indicates improved profitability. This indicator shows you that there is a higher return on investment for a given company or stock, which in turn attracts more investors. This boosted interest coming from investors often drives stock prices upward. In addition, it improves investor confidence and creates healthier economic conditions, which also contributes to an upward trend in the stock prices. Price-to-earning ratio. Another important indicator to check is the company's reported price-to-earnings ratio. When there is a rise in stock price for every earnings per share, more investors will tend to sell their shares. Price-to-earnings ratio rises when a company's earnings start to drop. What you need to do is to monitor the rise and fall of price-to-earning ratio so you can determine if investors are buying or selling their shares. When more investors are buying, then expect a bullish trend to come along. Bear market signals. A bear market is one that is characterized by a decline in prices. If a stock undergoes a decline in price of around 20% or higher over 2 months or more, then you can say that it's getting bearish. If the decline is only around 10%, below 20%, you can safely say that the stock is only going through a price correction. As an investor, you're typically looking at important economic signals such as interest rates, inflation, wage growth, and the amount of hiring being made. When a country's economy shrinks, expect corporate profits to go down as well. The good news is that bearish trends tend to be shorter compared to bullish trends. On average, a bull market lasts 1,742 days, and a bear market usually lasts 363 days. Average losses during bear markets amount to 33%. However, the average gains during a bullish trend can go up to 159%. Chapter 4. How to spot stocks that are about to explode. In order for you to spot a stock that is about to explode higher, you need to identify catalysts in its daily charts. For example, you can look for a trend in a 5-day setup and you'll notice certain incendiaries that will spark a change in the patterns. Note that you're not just looking at daily charts, but you're trying to spot a potential change that is going on for several trading days. For instance, if you see a trend of higher highs and higher lows in one trading day, you can confirm the trend by observing the stock's price pattern the next few days and wait for certain catalysts. What catalysts to look for? Here are some of the catalysts that you're looking for that will signal that a stock is about to explode in an upward trend. 1. an upward trend with continuations in small time frames. Some investors would be afraid of taking a position in a stock that has a strong upward trend, fearing that it can enter into a reversal. When that stock corrects, the price will drop and you will end up losing a lot of money. However, if you can spot an upward trend with small continuations in shorter time frames, then that is a strong indicator of an upward momentum signaling you to buy. What you need to do next to confirm the uptrend is to zoom into a shorter time frame. From the already mentioned daily chart, you can switch to a 15-minute chart. If you see a bullish trend in the shorter time frames, then it confirms a strong upward momentum. 2. Rising 50-day moving average. Another catalyst to look out for is a rising 50-day moving average. A stock that's surging upwards but then corrects right into a rising 50 moving average indicates a continuation of an uptrend. If the stock price corrects near or at the rising 50 moving average, then it tells you to buy into that asset. However, if the price falls below that, then the upward momentum isn't confirmed. 3. Stock price nearly reaching the 20-day moving average. Just like the rising 50-day moving average, the rising 20-day moving average is also a very useful tool for finding securities that are about to explode upwards. The difference is that the 20-day moving average is the tool you'll use to check securities that seem to be consolidating or in decline. If the price consolidates near but never goes below the rising 20-day moving average, then it indicates that the stock or security is about to go in an upward momentum after a short consolidation. However, if the price goes below the rising 20-day moving average, then an upward momentum isn't confirmed and a trend reversal may be coming along. Chapter 5. When to exit a position. You can use the same tools mentioned earlier in the previous chapters to determine if a stock is going to continue in an upward trend or enter into a reversal. For instance, when the stock prices crosses the rising 50 or 20-day moving average lines, you should take a short position on the said stock and take profit before the downtrend begins. The stock hits your target price. It's crucial that you set your target price when you enter into a trade, especially when you're dealing with momentum stocks. Many investors use this strategy, and so should you. When a stock reaches your target price, then you should start to sell. Don't hold and wait for a higher price because you can't always tell when a reversal will occur. Always play it safe and use discipline. When the stock price hits your targets, then sell even if it seems that the trend will still continue upwards. Follow your technical signals. We have mentioned several key technical indicators in the previous chapters that you can use to confirm an upward momentum. The same indicators will also tell you if there is no longer a continuation of that upward trend or momentum for a given stock. These indicators can be used to establish a predetermined sell signal. An example of this is by using a simple moving average. If you find that the stock you've taken a position on has begun to decline, you can check your moving averages to confirm the trend reversal. A declining stock that has its 50-day moving average crossing below its 200-day moving average is definitely on a decline, and it means it's time to sell. It is a strong indicator that there is a change in the trend, which means it's a good time to exit your position and take profit. Check for fundamentals. Apart from the charts, you should also check out market news and other fundamentals to confirm a potential downtrend in stock. For example, if there is news about the company being acquired or it will be merged with another company, then it can be a good signal to sell. There is a lot of volatility when acquisitions and mergers happen. However, it might also be a good idea to check other fundamentals to see if the acquisition is good for the business or not. Conclusion: trading and investing in momentum stocks isn't for everyone. If you're doing it for the first time, it is highly recommended that you try it out on paper trading first, so you don't risk any money. You need to be able to read the technical and fundamental indicators properly to determine momentums and declines in prices. It takes a lot of practice to spot upward trends that you can profit from. Equally important to that is the ability to spot a decline in the trend and sell before a change happens. We advise you to learn more and try out the principles mentioned here before you invest any real money on momentum stocks.